Hello, and welcome to all our savvy viewers on Finance Pros. Today, we're diving into a critical topic for anyone looking to make the most of their money. Have you ever wondered if keeping your savings in the bank is truly the best option? Well, it's time to broaden your financial horizons. In this video, we're going to explore 6 assets that not only offer better returns, but are also safer than letting your cash sit idle in a bank account. Whether you're a seasoned investor or just starting out, understanding these alternatives is key to building a robust financial future. So stay tuned, because we're about to unveil some valuable insights that could transform the way you think about saving and investing your money. The limitations of keeping cash in the bank. Let's start by addressing why keeping all your cash in the bank might not be the wisest financial move. Firstly, have you checked the interest rates on your savings account lately? They're often disappointingly low, barely keeping up with inflation. This means that over time, the purchasing power of your cash could actually decrease rather than grow. Inflation is like a silent thief, gradually eroding the value of your money. With average inflation rates often outpacing the interest earned in standard savings accounts, your cash isn't just sitting there, it's slowly losing its worth. Moreover, by not seeking out more lucrative or secure investment options, you're missing out on the opportunity to grow your wealth significantly. In essence, while banks offer a high degree of safety and liquidity, the trade-off is minimal growth potential. It's like having a sturdy, leak-proof boat that isn't going anywhere. Sure, you won't sink, but you won't get far either. So what are the better alternatives? Let's explore 6 assets that can serve you better than your traditional bank savings. Government bonds. First up, we have government bonds. These are essentially loans that you give to the government in return for a fixed rate of interest over a certain period. What makes them a safe bet? Well, the likelihood of a government defaulting on its debt is generally low, especially in stable countries. This means you can expect to get your money back plus interest. Government bonds are an excellent way to earn a steady income, as they typically pay interest regularly. They're also a fantastic tool for preserving capital. However, the trade-off is that they usually offer lower returns compared to more aggressive investments like stocks. But for those looking to dip their toes into the investment world without taking on too much risk, government bonds can be a solid start. You can invest in government bonds directly or through bond funds. Direct investment might be more straightforward, but requires some research, while bond funds offer more diversification and are managed by professionals. High-yield savings accounts. Next on our list are high-yield savings accounts. These are not your average savings accounts. They offer significantly higher interest rates, making them a powerful tool for growing your money more efficiently. This is particularly beneficial in times when traditional savings accounts offer minimal returns that struggle to keep pace with inflation. High-yield savings accounts maintain a high level of safety, similar to regular savings accounts. They are often insured by the government up to a certain limit, providing an added layer of security for your hard-earned money. This feature is crucial for those who are cautious about where they park their savings but still want better returns. The appeal of these accounts lies in their unique blend of safety, enhanced returns, and liquidity. You can access your funds relatively easily compared to other investment forms, making these accounts an ideal choice for your emergency fund or short-term savings goals. This accessibility ensures that you're not locking away your funds for long periods, giving you the flexibility you need for unexpected expenses or opportunities. However, it's essential to shop around as interest rates and terms can vary significantly between financial institutions. This variance means that with a bit of research, you can find an account that best suits your financial needs and goals. It's also important to be aware that these accounts might come with more restrictions than your standard savings account. This could include higher minimum balance requirements or limited transactions per month. While these conditions might seem daunting at first, meeting them can be well worth it considering the extra interest you'll accumulate over time. Such requirements are often in place to encourage savers to maintain a more substantial balance, thereby maximizing the benefit of the higher interest rates. Real estate. Moving on to a more tangible asset, real estate. Investing in property can be a particularly lucrative way to grow your wealth. Unlike more ephemeral investments, real estate offers something you can see and touch, and it often appreciates in value over time. This not only provides a hedge against inflation, but can also result in significant capital gains. The beauty of real estate investment lies in its versatility. You can choose from various options, such as purchasing a single-family home for rental income, investing in multi-unit residential properties for larger-scale rental earnings, or even exploring commercial real estate. Another accessible route for those who may not have the capital for direct property purchases is investing in real estate investment trusts, REITs, which allow you to invest in property portfolios. However, it's crucial to acknowledge that real estate investment demands more capital upfront compared to other asset types and is typically less liquid. The potential for long-term growth and income, though, can be substantial. Success in real estate hinges on thorough research and precise timing. Understanding the nuances of market dynamics, the significance of location, and the characteristics of different property types is essential. Potential investors should also consider additional costs like property taxes, maintenance expenses, insurance, and potential property management fees. When approached with diligence, a clear strategy, and a long-term view, real estate can serve as an exceptional tool for wealth building and financial security. It's not just about buying property, it's about investing in a tangible future. Stocks. Stocks are another excellent alternative to keeping cash in the bank. By investing in stocks, you're buying a share of a company, which could potentially increase in value over time. The stock market has historically provided higher returns than savings accounts or bonds, albeit with higher risk. Diversification is key when investing in stocks. Don't put all your eggs in one basket. Instead, spread your investment across different sectors and companies. This reduces the risk and smooths out the volatility in the market. For beginners, starting with a small, manageable investment is wise. You can gradually increase your investment as you become more comfortable and knowledgeable. Remember, investing in stocks is a long-term game. Patience and a steady approach can yield significant rewards over time. Precious metals. Precious metals like gold and silver have been a store of value for centuries. They are tangible assets that can act as a safe haven during times of economic uncertainty or high inflation. Historically, precious metals have maintained their value over the long term. Investing in precious metals can be done in various ways, such as buying physical gold or silver, investing in precious metal funds, or buying stocks of companies involved in precious metals. While they don't offer dividends like stocks, their value often moves inversely to the stock market, providing a good balance in your investment portfolio. It's essential to understand that precious metals can be volatile in the short term and don't generate income like stocks or bonds. However, as a part of a diversified investment strategy, they can add stability and security to your portfolio. Index funds. Last but not least, we have index funds. These are a type of mutual fund or exchange-traded fund, ETF, designed to track the components of a financial market index, like the S&P 500. Index funds offer broad market exposure, low operating expenses, and low portfolio turnover. These funds are excellent for those who prefer a set-it-and-forget-it approach. Since they're designed to mirror the performance of an index, they require less management and typically have lower fees than actively managed funds. Index funds are a great way to diversify your investments across a wide range of companies and industries, reducing your risk while still capitalizing on the growth potential of the stock market. They are particularly appealing for long-term investors looking for a low-maintenance, yet effective way to grow their wealth, while keeping cash in a bank is safe and accessible. It's not always the most effective way to grow your wealth. Until next time, keep exploring your financial options and take control of your financial future.